Hope everyone's doing well and had a good day. This is the Emini review for May 24th, 2024. And because it's Friday, we're going to take a look at the weekly chart, support and resistance. Weekly support and resistance, always important going into the end of the week. And we had the high of last week, the low of last week. And you can see this week we broke out above last week's high and then pulled back. And I said before, this is a high one on a higher time frame. And all that really means is we had this strong rally and then a deep sell-off. And this was deep enough to disappoint the bulls. So the odds are when we come back up and test where the bulls were trapped and disappointed, the odds were we would go more sideways to down here because you have bulls who bought up here, scaled in lower, and they were looking to exit at their original entry. With the daily chart, yesterday we had that big outside down day. And so I thought coming into today, the odds were at least slightly higher that today would be either an inside day or at least a smaller day. I thought the bears would be disappointed with the follow-through. And the reason we had that big bar yesterday, or at least one of the reasons, when you think about it, we had this rally, but we're in a trading range, and when the market gets too far from the moving average, you have to ask who is buying up here. And the reality is you have bulls buying up here who are buying momentum. And because we're high above the average price, they're not value buyers. Value buyers buy when it's cheap. And you can see we're far below the moving average. So people buying here. So traders who are buying here are buying value. Up here, they're buying momentum. And when that momentum dissipates, we start to go sideways and we're still far above the average price. The market has to go lower to find buyers because the bulls are going to be no longer willing to buy up here. And we should get a test of the average price before long. But like I said, it's a big bear bar in a tight trading range after a rally. The odds were the bears would be disappointed with their follow-through. Because it was such a big bar, like I said again, I thought the odds were greater that we'd have an inside day today. Now with that said, you can see where we gapped up to on the open. And so I usually draw yesterday's low and yesterday's high. But I also think the midpoint of yesterday would be an important price. So I'll go ahead and draw that as well. So here are the high and low of yesterday. And then the midpoint is about here. And I thought that price would be a magnet. So I'll go ahead and draw that. And we'll just add the text. And with that, go ahead and get started with the review. Bar 1. Bar 1 is always an important bar. Bar 1 can hint toward the type of day you're going to get. And when you get a trading range bar on bar 1, that typically is a hint that the day will resemble some sort of trading range. And anyway that most days are going to be some type of trading range day. So we gapped up, and bar 1 was a bull reversal bar, but it has a small body. It's basically a doji, and the odds are there are sellers above. But because of the gap up, this is a high 1, is an implied high 1. There's no technical pullback on this chart, but this is a high 1 buy setup, and you may have bulls buying after this breakout. But the problem, when you look to the left, this sell-off was so steep and so strong that the odds are Even if we do pull back, we'll probably get some sort of second leg down. And bulls who are buying know that. So bar 1, probably buyers below and probably sellers above. And then bar 2, traded above bar 1, triggering stop orders and then reverse down, and we have a bear bar closing on its low. It's the first reversal down after the gap up, and that lowers the probability. But it is a bear bar closing on its low, and some bulls will get out because of that. On the open, especially the first 6 bars or so, I'm expecting a trading range, and because most days bar 1 is not the high or the low of the day, I'm also expecting to go below bar 1. Reversal bar on bar 3. Now we have a high 1 signal bar for the bulls. It's a bull bar closing on its high. That's good for the bulls. The problem with high 1s is you have bulls disappointed by either bar 1 or by bar 2. Now this wasn't a major disappointment. It's really just one bar, and it's not all that big. And we have the magnet of the midpoint of yesterday above. So I still think we're going higher. But we may have to come below bar 1 before we do. And then bar 4, outside down. So triggered the high 1 and trapped bulls into a bad trade. And if they used a tight stop below bar 3 or bar 1, they were immediately stopped out. The problem with bar 4, it's a big bear bar, but it has a big tail below, and it's overlapping the first 3 bars of the day. It's a trading range bar, and I say it all the time, it's an expanding triangle on a smaller time frame. So do you really want to be selling below bar 4, which is low in a trading range, after a gap up? Probably not, and there's probably more buyers below. Follow through selling on bar 5, and that's good for the bears. The problem, we have the moving average support below, and even if we do continue to fall, the odds are there are bears who sold above breakout points here, maybe the close of the prior day, and the odds are if we get down there, they'll look to exit their shorts and will probably at least bounce. Another problem with bar 5 is that this is a trading range. If you look at the first 4 bars of the day, they all overlap. Now we're getting a bear breakout of a trading range, but the breakout bar is not especially big. And if we are getting a breakout, you can see a measured move of this trading range is just about to the moving average. So the odds are the downside is limited here. This was strong enough for the bears to get a second leg. Some traders will argue bar 2 was the first leg and then bars 4 and 5 were the second leg. But this was probably strong enough for its own second leg. You also have to remember that we're on the open. So trading range open and any breakout on the open, no matter how strong it is, has about a 50% success rate. And because of the tail and context, the tail on bar 4 and the context of the breakout, this has no better than a 50% chance of getting a measured move down. And then bar 6, disappointment. Probably buyers below 6. It's an inside bar, and that lowers the probability for bulls buying above. Plus there's a tail above. And again, the prior 2 bars, 4 and 5, were strong enough that we'll probably go a little lower before we reverse. Now that second leg for the bears could be as small as 1 bar, and it could even be the tail of 1 bar. And instead we broke up to the outside. We broke out to the upside on bar 7. You can see there's a tick gap. There's a gap from the close of bar 6 to the open of bar 7. Bar 7, 10 o'clock Eastern time, is a typical time for a report, and it's always good to be aware of that. I wouldn't trade reports or any news, but just knowing that that could happen is good to know. So bull breakout on bar 7, but closing within the trading range. Now we went far enough up, even though it closed within the trading range, we did break out above it. And it could be the expanding triangle continuing here. Maybe it's 2 or 3 legs up, 2 or 3 legs down. But right now it's not all that clear, and this is a really minor pattern. And bar 7 was a strong enough breakout that it'll probably get a second leg. Bear breakout failed, and now we're getting the bull attempt. With the gap up, I think it could be the gap up was leg one, pull back, second leg, and possible second leg trap. Bar 8's an inside bar, and it's disappointing for the bulls. You can call it a high one signal bar. Either way, the odds are, because it's an inside bar, it's a high one. It's a micro double top with bar 7, and a double top with maybe bar 2 over here. Odds are there are sellers above, but they're selling for a scalp. Traders know bears got trapped selling above bar 5, selling above bar 6 on bar 7, and any pullback will lead to a bounce. Another doji on 9. It traded above bar 8, but bar 8 was an inside bar and a high one. The odds were there were sellers above. But if that's your entry bar as a bear, to me what it looks like, we had a bull breakout on bar 7, and then we went sideways for 2 bars. And as it's not ideal for the bulls, but what the bulls are doing is they're preventing the bears from getting a close. So it looks like we've had 4 bars since the bears have controlled a bar. Now you can argue bar 9 is actually a bear bar because it closed below its midpoint, but it doesn't have a body. So right now we have a bull breakout and then a couple of bars sideways, which could simply be a pause before a second leg up. Probably buyers below bar 9. And then bar 10 broke out above bar 9, going a little higher. Could be the start of the second leg up, leg 1, pause, and then leg 2. We have the midpoint of yesterday, magnet above, and for the bears, what are you looking to sell? It's hard to come up with a decent stop order sell for the bears. Now, if bar 11 is a bear bar closing on its low, that would be reasonable for a swing, possible double top high of the day. But for now, there's nothing to sell. And we continued higher on bar 11. We're always in long, probably going at least a little higher because the bears, again, just do not have any setup here. Now, what about 3 pushes up? Could be, but you have to wonder if the bears have enough selling pressure. These bars were decent, but after these bars, possible sell vacuum test of support, and then we reversed up pretty violently, and since then the bears haven't done much. So yes, 3 pushes, maybe a minor reversal here, but the bears need to do more before traders are convinced that this is a minor reversal. Every bar today has been completely above the moving average, so bulls are buying above the moving average. They've had over 10 bars above the moving average, and that's fairly impressive. Another bull bar on 12. Remember that bar 12 corresponds with the 60-minute chart, and so we had a tail below the bar. Here's the open, tail below, and then the bar closed near its high. And that's a strong-looking bar on the 60-minute chart. We have a micro channel since bar 5. No bar traded below the low of the prior bar. The odds are, well, first of all, when micro channels get to 7 or more bars, the probability of a pullback becomes greater than continuation. But pullback means, and it depends on context, but with a micro channel, pullback usually means minor and that there are buyers below. You can see here, we have about an 8-bar micro channel. We are approaching the magnet, the midpoint of yesterday, and this moving average up here corresponds with the 60-minute chart moving average plotted on the 5-minute chart. It's a 221 bar exponential moving average. Probably going higher and probably buyers below bar 12. And then an inside bar on 13. The bears are hoping it's a final flag and that we get the failed bull breakout and reversal. Bulls, they're buying on momentum right now. The context isn't great. We had this huge sell-off, and now we're getting a rally. So probably a trading range, big down, big up, big confusion. But the problem for selling here, until there's more selling pressure, who knows? This could be the high of the trading range, or it could be all the way up here. Inside bars are lower probability, probably sellers above, and probably buyers below. And then bear breakout 14, but it's a small bar, and it's the first bear trend bar since bar 5, and it was after a 9-bar micro channel. Odds are traders will buy bar 14, at least for a test of the bar 12 close. And then 15 sold off deeper. So bear breakout and then follow through 15, probably strong enough for a second leg down. You can see we're testing breakout points to the left here. We broke out above bar 2, and we're coming back to test it. What do you think a bear will do if they sold above bar 2 and got trapped? Probably look to take what they can get on the pullback and exit at their original entry price. But again, 15, this 3-bar or 4-bar micro channel, was strong enough for its own second leg. The bulls will wait for that second leg and maybe a test of the moving average before buying again. And then 16, bull trend bar. You can see what happened. The bears, they have a 4-bar micro channel since bar 12, and bars 14 and 15 consecutive trend bars, but they're both completely above the moving average. And this is still the first break of the micro channel. Odds are this will be the first leg, and any pullback will lead to a second leg. I still think this was strong enough for a second leg, so I'm not sure if traders will buy above 16, but 16 is a bull bar closing on its high. If always in bulls exited, they can enter again above that bar. And then another bull bar closing on its high, 17. Breaking out to a new high of the day, but just barely. And the bulls really want follow through here. We're really approaching that midpoint of yesterday, and traders are paying attention to see what happens at that price. Bears are hoping this sell-off might lead to a 50% pullback, and maybe it's a wedge, but again, the selling pressure could be better for the bears here. The bulls are controlling more bars. You're having bull bars closing near their highs. And then 18, we broke through the midpoint of yesterday and tested the 60-minute moving average. Another 3 or 4-bar bull micro channel. The odds are the first reversal down will fail, and the bulls are looking for a symmetrical second leg, so there might be more to the upside here. It's a bull channel, but when you think about a bull channel, you have to be thinking bear flag. More often than not, bull breakouts of bull channels fail, and they have about a 25% success rate, which means anytime there's a breakout of a channel, in general, there's a 75% chance the market will reverse within 5 bars and then test the trend line. And here's the bull trend line. So then bull breakout 19. It's a good looking bar. It's a good looking breakout. The reality is it'll probably get a second leg. But what I just said, there is a risk to buying here. Bulls know if they're buying, they're doing a low probability thing, and they need the momentum to continue. We're far above the moving average. It's becoming parabolic. You can see the trend line is getting steeper, and that's unsustainable for the bulls. Just want to demonstrate. So the channel line is getting steeper. We're getting big bars, and that's a warning that this is a parabolic wedge and we could pull back. The problem with selling parabolic wedges, you could argue it's 3 legs up with the gap and then this and then leg 3 here. But when you look at, it's more easy to see on a higher time frame. This is just a breakout on a higher time frame. And it's really hard to want to sell a breakout like this on a higher time frame. Even if you just looked at the 15-minute chart, that's a great example. We're at 11:05. So somewhere during this bar, do you really want to sell here? Probably not. But again, this breakout is more likely to pull back than convert into an even stronger bull trend. More follow through on 20, but why is it such a small bar? That's going to make bulls suspicious, especially when they're buying momentum far above the moving average in a parabolic wedge. You will have traders look to buy lower, take profits up here. 21 continuing even higher. It's about an 8-bar micro channel, becoming extreme in several different ways. For me, I don't know. If I was long, I'd be looking to take profits here. And if this continues without me, then that's okay. Just wait for the next trade. Bear bar 22. The problem with bar 22 for the bulls is what I've been saying. We're rallying far above the moving average in a parabolic way. And whenever you get a bear bar closing below its midpoint, as Al says, it's wise to get out below it because you could easily get a sell-off that tests back to the moving average or to breakout points. Bar 12 was a breakout point. The market broke above it, never retested it. And if we're going to have a trading range day, that could be a price that we come back to. I think today's less likely a bull trend day, considering what happened yesterday. And we're inside the range of yesterday, which was a big sell-off. That will reduce the probability. Plus, the parabolic behavior here, it looks like the bulls are becoming exhausted early. This type of buying is not sustainable all day. It's really rare to see a day like this just continue all the way up like that. 22, okay to exit, longs below, probably sellers above. 23, high one buy, there's probably sellers above. This was strong enough for a second leg, but the pullback could be deeper than just 2 bars here. 24 continuing down. Now we have a micro channel since bar 22. The bears are hoping they trap the bulls and it's an endless pullback. The bulls know the odds are if they bought and got trapped, they will be able to scale in lower and make money. So what do you do here? The market looks like it's converting to a trading range. With the parabolic behavior, the bull breakout is now getting bad follow-through. Traders are wondering, will we come back and test the trend line or the midpoint of yesterday, the breakout point? There are now several magnets below. The bulls are hoping we get a measured move up of the spike. The measured move could be up here, but the problem for the bulls here is risk-reward. If you bought up here, let's say you bought 21, and while there's momentum, and you say there's a 60% chance I put my stop below 16, I go for the measured move up, and I go for 1-to-1. Well, when you start getting 3 bear bars, the probability is no longer 60%. And because bulls are buying momentum, and the momentum is dwindling, you might have more and more traders give up. Now, I still think we'll get a second leg, but I'm not sure if we'll get it here and then pull back, or if we'll continue down and then get the second leg. Bull bar 25, high one, triggered above 24 technically. Some traders will call 25 the high one, but bulls who bought 21 got 3 bear bars against them. The odds are they're disappointed and they'll look to exit back at their original entry. So probably sellers above and trading range here. And it looks like bulls were so disappointed they didn't even get back to the close of 21 before everyone bailed out of the trade. Now, why did this happen? Remember what I said, or really what Al said, about exiting below a bear bar, closing below its midpoint. The risk is real that you can get a bar like 26 where bulls are buying all the way up, the momentum dissipates, and then everybody bails out of the trade and looks to buy lower. Remember, it was also a breakout of a channel, and they usually reverse within 5 bars. So let's say breakout here, 1, 2. After 3 bars, we reverse back down, and we may come back and test the trend line here. Plus the midpoint of yesterday, looks like we're getting vacuumed down to that price, and the moving average is right there. So there is support below, and 26 is a second leg down and a possible second leg trap. It's a really good looking bear bar, but it's completely above the moving average. It's at the 60-minute moving average. It's right at a cluster of support, and the odds are there are buyers below. The context is bad too. With this rally, more likely a trading range, and we bounce. And then 27, a bull bar. It's an inside bar, and that lowers the probability. 26 was such a strong bar, it'll probably get its own second leg down. 27 is testing breakout points to the left, like the bar 24 or 25 low. And you had bulls buying here who got trapped on 26, and 27 might be giving them an opportunity to exit at break even. And if they get that opportunity, they might take it, and that will contribute to the selling that leads to the second leg down. 27, some bulls will look at it as a high two, so rally, 2 legs down, and then a high two above 27. But really steep pullback here, possibly 1 leg, and then we get a deeper pullback before a second leg. 28, another inside bar, so II pattern, it's breakout mode. And that means the market is going sideways. It's a trading range on a smaller time frame. The market's getting squeezed, and the breakout could be up or down here, and 50% chance the first breakout is the wrong direction. And you can see we broke out to the downside, only to reverse on bar 29. Now 29 is a micro double bottom, and you can call it a high 3 wedge bull flag. It's a bull bar closing on its high. Some traders will buy above it. Others will say this was tight enough that this is probably minor, and we'll get a deeper second leg down before bulls will buy. But I do think it's okay to exit shorts above 29. But the risk you face is that this is a tight trading range, and entering or exiting on stops, you can easily get trapped. And then a disappointment bar on bar 30. So any bull who bought above bar 29, that's their entry bar. Are bulls elated that bar 30 went nowhere? No, of course not. It looks like the trading range is continuing and we're going sideways. Probably sellers above and buyers below, but it is breakout mode, so expect a breakout. Or at least don't be surprised when there's a breakout. 31 continuing higher, so it's a small bull bar, but still within the range of 27, which was the start of the trading range. Probably sellers above 27, which would be also above bar 31 here. And it could be bear breakout, and then 1 leg up, pull back, second leg up, before a second leg down. 32, a doji, failed breakout of this trading range above 27. Some traders will see it as a low 2. It's a low 1 below 28, and then a low 2 below 32. But a couple of doji bars and a 4-bar micro channel might reduce the number of sellers below. Plus there's a cluster of support below, both moving averages, the trend line, and the midpoint of yesterday. Continuing higher on 33, the bulls able to close the gap from below bar 24. You know the market's in a trading range with big up, big down, big confusion. And when the market's in a trading range, gaps close. So any bull, I think I mentioned that earlier, any bull who bought here and scaled them lower probably make money. And they may have had that chance on 27 and then exited the trade. Others, they might have waited for the low 1 below 28 to buy, or buying above a bull bar closing on its high, like bar 29, and then hoping for this rally. But the rally's weak, and you can see it as 3 pushes up on 29, pause, up on 31, pause, up on 33. So it is possible it's 3 pushes up, and we're getting high in a trading range. 34 continuing higher, but probably sellers above bar 26, the big bear trend bar. And then 35, a small inside bar. It's a high 1 with a bear close, probably sellers above, but micro channel since 29. That will reduce the number of sellers below. 36, outside down. So we triggered the high 1 and then reversed down, which was expected. But the problem with selling 36 is it's the first reversal down in this micro channel. Now the context is not all that bad, because compare this micro channel with either one of these, this one or this one. Like I said, this one is constructed with climaxes. It's a bull push, pause, and then another push, pause, another push. It's a wedge on a smaller time frame, and it's really a wedge and a double top with 29. And traders were expecting a second leg after, excuse me, I said 29, it's bar 26. Traders are expecting a second leg after 26, and traders will wonder, was that enough of a second leg? One thing to note, markets like symmetry, and whenever there's a second leg, or whenever you're expecting a second leg, traders will wonder, was this the second leg, or was this all part of one leg? And then we get a deeper pullback that leads to a more symmetrical second leg. 37, going down a little further, testing the bull trend line. And the bears are hoping we have a rally, trend line break, a lower high, major trend reversal. So bar 36 is a bar where bulls okay to exit longs below and bears will short, and hoping for a major trend reversal. There's about a 40% chance we get a major trend reversal here. One of the problems with the setup is all day with 37 bars, we've had one bar test the 20 EMA. As far as what I'm expecting for the rest of the day and the day structure, remember I said it's unlikely we'll just keep getting buy climaxes like this, and you can see we got much weaker here. So the odds of us continuing up in a channel all day are low. Also remember that 80% of the days have at least 4 hours of trading range price action, and that could have started on bar 22. So I think more likely the market's in a trading range, probably buyers below here, buyers at the breakout point, and then sellers at new highs and above here. But for now, the bears have had 3 consecutive bars. It's enough to disappoint the bulls here, and this rally was already weak and a lower high. So for the bulls, like I said, I'd be out of longs below 36. Another bear bar, 38, testing the moving average for the second time today. This time, compare this moving average test with this one. We had a sell climax, bull bar, sell climax, bull bar, sell climax. Over here, we're just getting consecutive bear bars, and now the bodies are getting bigger. And that's obviously stronger than these sell climaxes over here, especially after this rally. This one is following a weaker lower high rally. So there might be more sellers below, but the moving average will be support, and the bulls are expecting a second leg up after this rally. So bar 39, a bull bar, but it's a trading range bar, basically a doji, and probably sellers above. Micro channel since 36, and bulls who bought anywhere up here, say they bought the close of 34, bought below 34, they're disappointed with this sell-off and they'll use any bounce to exit. Inside bar 40, if you're a bull and you're long up here and this is what you're getting, the bears are hoping it's a leg and then a pause and then a second leg down. The bulls are wondering if they'll get a chance to get out. Now it is a trading range. The odds are if you use a wide stop and scale in, you will be okay. You'll probably close gaps. And we do have a gap from the bar 34 low, breakout on 38. We'll probably get back up there, but it could be a while before we get up there, or it could happen now. And then 41, we went right there. 41 is a strong looking bull bar. It's a bull bar closing on its high. It's a good looking trend bar, but look to the left and ask yourself, what's the context? I was just saying there are bulls who are trapped over here. And if they get a vacuum test, first of all, why do vacuum tests happen? Look at this leg down, and you know it's orderly and it's made up of several bars, and it went a fair distance down. You know we're probably getting a second leg after this. What happened was you have bears unwilling to sell because it's a micro channel. You have bulls buying below because it's a micro channel. and both get trapped. The bulls get trapped into a bad trade. The bears get trapped out of a good trade. So now you have bulls looking to sell up here, and you have bears looking to sell up here. The market has to vacuum up to find those sellers. So the problem with buying 41 is that it could simply be a buy vacuum and test of resistance before a reversal down. Now it was a strong bar. There might be more to the upside, but the odds are there are sellers above. And look at that on 42. We didn't even trade above 41, and traders just sold the close of 41. And then 42, strong bear bar, but similar problem as 41. You have to ask yourself what the context is. It could be a nested 2 legs down, so it's leg 1, pull back, leg 2, and it could be leg 1, pull back, leg 2, getting low in the trading range. There is some room to the downside, and 42 is such a strong bar, reversing 41, that it'll probably go at least a little lower. But the probability is there are buyers below. And then follow through for the bears on 43. It's a low one on a smaller time frame on 43. Now the bears have consecutive bear bars closing on their low. Is it always in short? I don't know. It might be. But the problem with always in a trading range is it always becomes always in short at the bottom and always in long at the top. So when you look at this context, the market's in a trading range. Better to look to buy low and sell high. And so maybe even if it is always in short, I would not be too eager to sell here. Again, like I said, possible nested 2 legs down. Another bear bar on bar 44, but you can see we're slowing down and testing support. The bulls are hoping we get a double bottom with bar 29. 2 legs down and then a decent bull signal bar. The bears are hoping we just continue down and test lower breakout points like here. And then instead 45 was a good looking bull bar. 45 is a bar where, first of all, like I was saying, even if it did flip to always in short, that's the danger with always in a trading range. Do I think it was always in short? I don't know. I don't think so. And like I said, it's because it's a trading range. So when you're low in the range, you really only want to look to buy. And then 45. The context is better for 45 than it was for 41 because you now have 2 legs down, you have a double bottom, and you're crossing the moving average. And that's all good for the bulls, but this might have been strong enough that it'll get a second leg, and traders selling above bar 44 who are trapped on 45 will probably be able to sell higher and make money. But 45, I think if you're short, it's okay to get out above 45. Disappointing follow through on 46 for the bulls. The bulls hoping it's a double bottom and maybe the trend continues. But like I've been saying, I'm not expecting the trend to continue all day, and I am expecting a trading range. Now the high of the trading range could be all the way at the high of the day, and we may have to get up there. But we could also test lower before we do. And with 46 being disappointing for the bulls, the upside might be limited. 47, another bull bar, but possible second leg. 45, pause. 47, and testing an area where bulls got trapped on bar 41. Think about the unlucky bull who was buying the close of bar 41. If the market gives them a chance to exit back near their original entry, they'll probably take it. That was here. And look what happened on 48. Broke above that price, broke above bar 42, and then reversed back down. And now we have a low 2. It's technically a low 1 on this time frame, but most traders might see it as 2 legs up and a double top with 42. The sell signal bar is weak. 48, it's just a doji, but it is a trading range, and we might be high in the range. And the bulls who got trapped here, looks like they won't look to buy for after a couple legs down. And then 49, a good entry bar for the bears. Could have been better if there was a tail below the bar, but any bull who bought below 48 is trapped, and there's probably sellers above 49. inside bar 50. But inside bars have lower probability. They're trading range bars, so even though it's a bull bar closing on its high, it's a small bar, and there's probably sellers above. The bears probably get a second leg down. Bar 51 could be the second leg that the bears get, but what's happening here is the market is getting squeezed. Some traders see it as a triangle. Doesn't matter how you see it or what you call it, as long as you recognize that the market is getting squeezed. And you can see it was a wider range here, and it's getting more and more narrow. And at some point, traders will get squeezed out. One side will be forced to liquidate, and we'll get a breakout. Right now, it's a tight trading range, and it's a limit order market, so sellers above and buyers below. 52, inside bull reversal bar. Bar 52 is a bar that used to get me into a lot of trouble. I would see the triangle, and I would think this is going to be the signal bar that creates the breakout, and I would buy above 52. It's a bull bar. It's a bull reversal bar closing on its high, and I'd say we're going all the way up to the high of the day. I might have even gone for, didn't mean to do that. I might have even gone for a measured move of this trading range, the triangle. I'd buy above this bar and go for a move all the way up here. And obviously one of the big problems with that is the trader's equation. You can take that trade, but you have to realize your risk reward is so good, then that means your probability is horrible. And when you're buying on a stop in a tight trading range, you can expect to get chewed up. Bull bar 53. It's a small bar, still within the triangle, probably sellers above. And then 54, trying to break out of the triangle and failing again. 54 is now a 4-bar bull micro channel, but we're in the apex of a triangle, and at this point, it's a tight trading range. Probably better to wait for the breakout. Some traders will trade, and they will sell above bars and buy below bars because it's a limit order market. But for me, I think it's best to wait for the breakout and then judge its strength. Bull breakout 55, and now the bulls need follow through because it's not breaking all that far above the triangle, and we're only just above bar 48 where the bulls kept getting trapped. I can redraw, so we know that triangle is there, and I can also say possible 3 pushes up, and the bears might sell the close of 55, betting the breakout will fail. Even if we do go higher, the bulls need to break out above the high of the day. And even if they do that, the odds of this being a bull trend day, well, let's put it this way. What's most likely for the day is a bull trading range day. Second most likely, bull trend day. And then third most likely, a bear trend. You're probably not getting a bear trend after all this buying pressure. But after all this sideways, and with the context we're inside yesterday's range, the upside here could be limited. And now the market's getting squeezed in a triangle. We're getting 3 legs up with a lot of overlap and selling pressure. Probably need to wait for follow through if you're looking to buy here. 56 is follow through for the bulls, and that's good, but you need to judge the strength of the bull breakout. If this is a strong bull breakout, why is 54 a doji? And why are we still overlapping all these bars to the left? And you have to wonder if it's just maybe 2 or 3 legs up in a trading range and a buy vacuum. Remember what I said about buy vacuums. It's similar to bar 41. You have bulls and bears. First of all, you have bulls. This was a buy the close rally. So you have bulls who bought the close of 21, trapped here, disappointed, never got a chance to exit. Now a bull could have bought above 29. This is always interesting. There's a lot of lines on the chart, and I will erase this one right after I explain it, but I think it's interesting. If a bull bought the close of 21 and then they were trapped, but they had a wide stop and they bought more above a bull bar closing on its high, like bar 29, say they bought here, the midpoint of their two entries is break even on the entire trade. If the trade goes this far against you, you'll probably be happy to take that. And this line here, where my cursor is that average price, break even. And you can see we went a little above it before we reversed back down. So my problem with 56, bull breakout and follow through, but the context is bad. Could be two legs up here, maybe two legs up here. The context were high in a trading range. And most breakouts fail. And for me, I would be, if anything, looking to sell here. 57, a really disappointing bar for the bulls. If a bear sold above 54 and they got trapped, it only took 2 bars for them to get back to their entry price and avoid a loss. Now 57 is a high one at the top of a trading range in a weak bull breakout with a bear body. For several reasons, I think there are sellers above 57, and it might be one of those instances where traders are actually greedy if they try to sell above 57, and they're better off selling the close. But I will admit that is something I have not specifically studied enough to know. And you can see we did go above 57, triggering the high one. And what is bar 58? Yes, it triggered the high one, but this was strong enough for a second leg, and this could be that second leg, as crazy as it sounds. It's just 1 bar. Now I will argue it's 2 bars. We went up from 52 to 56, pulled back all the way down to the low of 57, and then on a smaller time frame we reversed, and there's a rally from the low of 57 to the high of 58, and that could be the second leg that the bulls get. And the problem here for bulls, similar to the test of 41 over here, it's basically the same thing. You have a couple legs up, nested 2 legs, high in a range, weak breakout. Now you have 58 testing the high close and turning down. There's a real chance that we can turn down to the downside here. And you can see what happened on bar 59. That's exactly what happened. You had bulls who bought here, and then they realized whether they made a mistake or they're buying, being aggressive, whatever the case, if you're long on the close of 56 and you get 57, you need to get out at your original entry price, whether you scaled it or not. And everybody sold on bar 59. Remember that we had a triangle. I will redraw that. Also, you can see by the close bulls, 21, we didn't quite get there, and now it looks like we're not getting there. Triangle here, and we had the bull breakout, but 50% chance the first breakout's the wrong way. Now we're getting the reversal. The bears are hoping we get the bear breakout here, and 59 is a strong bar, and the odds are we're going at least a little lower. 60, disappointing follow through for the bears. There is a breakout gap below 58 and 57. We may pull back to either one of those because it's a trading range, and legs in trading ranges, even though breakouts do get second legs, the second legs are often delayed after deep pullbacks. But the context here, you have so many disappointed bulls above. I'm not sure if bulls are willing to buy here. So 60, bad follow through, which is expected in a trading range, but strong enough down, you know we're probably going at least a little lower. 59 crossed the moving average, and it's a big bar. Now the context of 59 is terrible. We're in the middle of a trading range, if not the bottom, and so not ideal to sell here. Definitely better to sell above, and that's why traders will sell at the 57 low or the 58 low. And instead we're going lower on 61. It's an outside bar, so we traded above 60, which was a bad high one. It's a small signal bar after a big breakout. The odds were we'd go above and trade down, and now 61 could be leg 1, pause, leg 2, pause, leg 3. Some traders will see this all as one leg. Others, they see maybe 3 legs here. The point is, we're probably low in a trading range, and even if we do go lower, there's probably buyers below. And then 62, outside up, bull bar closing on its high. What about buying above 62? Some traders might, but when you look at this trading range, it's forcing you to enter on a stop in the middle of a trading range. You can see the midpoint is basically right at that bar. So that bar is actually a vacuum test of the middle of the range. And you're probably better off selling 62. I want to say one more thing about bar 61. Was it bar 59 leg 1, pause leg 2? It might be. But remember what I said about symmetry. And it's similar to thinking bar 26 was leg 1, and then these two bars were leg 2. The reality is you'll probably get a deep pullback and then a second leg. I think the same applies here. You have 62 testing the middle of the range. You have the breakout point with the low of 57. Maybe if bulls are lucky, bought below here, they'll get a chance to exit. But I do think the upside's limited, and we'll get a second leg down. 63, some traders will call it a low 2, double top, higher high double top with bar 60 and 63. For bulls, it looks like we triggered the buy above 62, and then they were trapped on 63. That's a disappointing bar. 62 might have been a strong enough bar to get a second leg, but the second leg could be something like 58, and that's if the bulls are lucky. Or more likely, we're probably going at least a little lower. And then look at bar 64, it's just like bar 58. Bulls, we had this bar 62, strong enough up for a second leg, and that right there, 64, could be the second leg. And what happened the last time we had that? We had a bull leg that was strong enough for a second leg, disappointment, and then a 1 bar second leg. You have to wonder if there will be sellers on the close of 64. And look what happened on 65. Really similar pattern to up here. And I'm going to pause and take a moment to take a screenshot of that because I think it's interesting and I want to build a slide on it. Bar 65, probably going at least a little lower. The bears are hoping it's a double top and we get a breakout below the neckline, which is the low of bar 62, and fall for a measured move down to here, which would close the breakout gap over here. The bulls are hoping we don't break out, but if we do, we reverse back up and we're low in a range and we get a couple legs up. The bears have the risk that this is leg 1, pull back. We go a little lower, leg 2. And there is buying pressure in here. The odds are we'll go more sideways, but we could go lower first. And then 66, going lower, breaking out below this double top, the neckline, breakout, closing below there, and that's good for the bears. But the context, look to the left and you see you're low in a trading range, 3 legs down. There's actually a tick gap here from the close of 65 to the open of 66. And depending on the context, that's a sign of strength or weakness. And in this case, more likely it's weakness. It's 2 legs down. It's nested 2 legs with a tick gap. And I think the odds are we'll probably bounce here. And then instead, we had the lower probability event happen. And when the low probability event happens, it's a surprise. And it happens quickly, and it happens in a big way. And that's exactly what bar 67 was. 67, being a surprise, is a leg 1 reset. So you know the odds are we'll probably get a second leg down. 67 crossed straight through the midpoint of yesterday and closed the gap with the bar 12 high over here. 2 legs down, but again, surprise, strong second leg, probably going at least a little lower. There is a risk for the bears. There's a big tail below the bar. Could be a second leg trap testing support. And then a disappointing bar, 68, but probably sellers above. It's an inside bar. 69, traded above 68 and then pulled back, probably in a trading range. Probably sellers above bar 67, probably buyers below 69 and maybe lower. And then outside up, 70, possible 2 legs up for the bulls. And as strong as a bar 70 looks, you're right at resistance where this breakout occurred. You had bulls. You remember what I said. I thought more likely we'd bounce here. So anyone who bought here, betting on a bounce, got trapped. And if we retest here, could easily bounce to the downside. 71, It's a bear bar, but it's a high one with a bear close and a bear flag, double top with 67, probably sellers above. 72, traded above, found sellers. Now 72 is a low 2 short setup. 69 was the low 1, and I don't think I mentioned it, but 69, a classic low 1 with buyers below. Now 72 is a doji, and is 72 a low 2 in a bear trend, or is 72 a low 2 in a trading range? It's obviously a trading range. The odds are there are buyers below, but we may have to go lower and test somewhere like the bar 67 close before we bounce and find buyers. And instead, there were buyers below 72, and we rallied and went outside up. The problem with bar 73, as strong a bar as it is, being an outside bar, outside bars are trading range bars, and it's 2 legs up, 1 pull back 2. We're at resistance, the moving averages. We're at a breakout point here, the bar 62 low, for several reasons, probably sellers around this area. The bulls got follow through, but it was minimum. One thing you have to realize is we're in the middle of a trading range. And at this point, when you're in the middle of a trading range, it's never ideal to be trading in there. I don't know if it's Al, but I've heard somebody with Brooks price action call it no man's land. Trading in the middle of a trading range is the worst place to be trading. Remember, you want to buy low and sell high. So 73 bull breakout, follow through 74, but the context is terrible. The follow through is a trading range bar, probably sellers above, buyers below, going sideways. 75 bear breakout, and we're testing to the left where bears who sold the low 2, they got trapped. We're getting a vacuum test near that price. If we get there, we'll probably bounce. 75 was so strong, and it's actually a low 3 below 74, but again, the context is bad. It might be low in a trading range down here, so we might go a little lower, but probably buyers below. Follow through 76, but similar problem as 73 and 74. Look at all the overlap and look at the follow through bars. It's just not ideal, and you're in the middle of a tight trading range. We're now within the last 10 bars of the day, and I just don't think it's worth doing anything here. Expect it to be a limit order market, and expect buyers below and sellers above. One more thing, because it's a trading range day, it is a bull trading range day. It is closing above the open, but one thing I want to look at is the midpoint of the day. Oftentimes on trading range days, whenever it's not a clearly bullish or bearish day, whenever it's not clearly closing near the high or the low of the day, traders will fight over the midpoint of the day. And you can see we are actually close to the midpoint of the day. So at a minimum, the bears are hoping we get down to this red line and close below it. They can claim that the bar closed as a bear trading range day, and the bulls hoping if we do go there, we reverse, but they're hoping we stay above it and close as high, as close to the high as we can. Remember what I said, 75 breakout, deep pullback, 76, and it's a follow-through bar, but it's a low 1 in a tight trading range, so probably buyers below going higher. And look what happened on bar 77. There were buyers below, and now 77 is a strong bull bar. Possible leg 1, pullback, leg 2, and that's what we're getting on 78. 77 and 78 look like decent bull bars, but again, the context is bad. 78 has big tails, and both bars overlap a bunch of bars to the left. Again, also late in the day, and 2 legs up, probably going more sideways here. And then 79, we went above 78 and then pulled back. 77 and 78 were strong enough for a second leg, but we're getting so late in the day, it's not worth doing anything, but probably buyers below 79. And we just went sideways into the close. For always in today, I thought by bar 1 closing, we had the gap up, and then a bull bar, maybe always in long there. And then you get the sell-off. It's probably a trading range, buy low, sell high, and probably buyers below bar 1. So it's either always in long or buy low, sell high. Then we have the bull breakout 7, and all the bars are still above the moving average, probably always in long or buy low, sell high. I thought it became more clearly always in long by bar 11 or 12. And then, of course, then one thing about the sell-off to 15, that was not enough to flip the market to always in short. It was a fairly impressive minor reversal. It was a trend line break, but what bears are looking for there is a weak retest of the high of the extreme, like bar 12, high or close. They're looking for a weak retest. They're looking for 16 and 17 to be weak bars. And instead, the bulls got a strong breakout. Always in long, clearly on 16, 17, 18. Probably buy the close in there. And did we ever flip to always in short? I think after you get bar 26, it's buy low, sell high again. So not clearly always in short. The bar is completely above the moving average after the rally up from bar 16 to 21 was much larger than bar 26. And so plus bar 26 is 2 legs down. So probably not always in short there, and probably became buy low, sell high in a trading range. And the reality is it remained that way all day long. Always in breaks down when you're in a trading range. So on smaller time frames, the market probably looks always in short by the close of 26, but you're in a trading range. And what happens when you're always in short in a trading range is you're low in the range, and then the market can reverse quickly. That happens all the time, all throughout the trading range. Might have flipped always in long on a smaller time frame here, and that's exactly when you should be looking to sell. And it just happens both ways all day. For stop order trades today, for the first 6 bars, I'm not really looking for stop order trades there. And bar 6 being an inside bar with a tail. Not that the context was terrible, but I can't say bar 6 is a great stop order trade. I think it's better to wait for higher probability there. You will have traders buying above bar 16, always in long, and if they did get out, you can get in again above 16, and then, like I said, buy the close rally, 17, 18, 19. When you get bar 20, a much smaller bar, you're getting a breakout of a channel and it's parabolic. You almost need to have your finger hovering over the flatten button, where you know the market is doing something that's low probability and it could easily snap back to the moving average or somewhere lower like the trend line. So if you were buying the close, I think you get out below bar 22. And then I thought buyers above bar 29, and it was 3 legs down. You can call it a double bottom. And I wasn't expecting the bull trend to continue, but I thought we could get back up to the 21 close. Could probably sell below 36. It's a lower probability because it's the first reversal down after a micro channel, but you have to judge the strength of the micro channel. The micro channel is made up of a wedge on a smaller time frame, and it's a double top with 26. And that made 36 a reasonable stop order sell. As far as anywhere in here, I don't know, it's tough. It's a tight trading range. I wouldn't advise buying above 45. You're in the middle of a tight trading range. Same with bar 48, same with all these bars. I mentioned I used to take trades like 52, and even though it rallied, I do not think that's a good stop order buy. I think it's a low probability. I think you could sell below 58, even though it's a bear bar. If it's a bull close, it is a bear bar. It's a sell reversal bar closing below its midpoint. And remember the context. Couple legs up, disappointed bulls. You know they're probably exiting at the close of 56. Some traders will sell on a limit order at that price. Others will wait for higher probability, sell with a stop below. And I thought the same thing was true here. Lower probability here because you've already had maybe a couple legs down, and now you're lower in the range. And for me, that would pretty much do it for stop orders. for limit orders today, I thought sellers above bar 1, buyers below bar 1, sellers above 9, and the market rallied. But if you did sell above 9 and scale in higher, you would have made money. Buyers below 13, but maybe not directly below. I think the first buy is below bar 12, and then more traders obviously bought below 11. Probably buyers below these bars, but when it becomes parabolic and unsustainable, you will have traders exit below a bear bar, closing below its midpoint. I thought sellers above 24. I thought buyers below 27 or 28. And then up here, the high 1, sellers above bar 35. Sellers above here in this micro channel, but deep pullback, maybe 50% of that bear leg. Up here, double top, sellers above 47 or above bar 42. Really, the sell for me might be the close of bar 41, and you'd get filled on 48. Couple legs down here, probably buyers below 50, sellers above 50. We went below. And then again up here, probably sellers on the close of 56 after you get 57. Bear breakout here, sellers above 60 or 61. And then what about sellers above here? You had that risk that it's 2 legs down and a second leg trap in a trading range day. And so for selling above, probably better to sell a deeper pullback rather than something like 30%, maybe 50% at a minimum. Bar 69 was a low 1, probably buyers below 69. And then we're in a trading range all in here, so buyers below bars, sellers above bars. But again, in this range, late in the day, usually better to do nothing. If anyone has any questions, please, if they're specific to the video, leave a timestamp and I will get back to you as soon as possible. Hope everyone has a good rest of their night.